So, good evening, everyone. My name is Amit Maheshwari. I'm the managing partner of AKM Global. We have several of our clients joining from US as well, US, UK. So, good morning to all of you. We have a full panel. I have several colleagues of mine. We are going to speak about the Indian budget, the tax, direct tax, and the indirect tax proposals. So, just in terms of our quick about us, we are a team of 600 people. I head the international tax and tax practice. Uh, all our clients, as most of you know, they are multinationals or clients which have something to do with cross-border transactions. We take pride in specializing in that area. We have clients from almost 30 countries now, and most of our clients tend to have complex cross-border tax issues, direct tax, indirect tax, FEMA issues, transfer pricing issues. The firm was launched in 1981, and as of now, me and Sumit Maheshwari, we are the co-managing partners of the firm. On today's panel, I have my partner Sandeep Sehgal, who is a partner in tax and regulatory division. I have Manish Garg, who leads our transfer pricing and litigation practice. I have Ikesh Nagpal, who leads our indirect tax practice. And I have Yeeshu Sehgal, who is our tax markets leader and is also leading the UAE office of the firm. So between all of us, we are going to cover all the direct and indirect tax proposals. In terms of the theme of this budget, I think I won't go into delve into much about the economic survey as well as what is the thinking of the new government. But the fact of the matter remains that even though it is a fresh third term, however, the theme is clearly continuity. So there's continuity of capital investment, macroeconomic stability, as well as fiscal prudence. So all the tax proposals which we will discuss actually basically reinforces all these themes. There are several rationalization measures. There are measures which are helping the startup community. There's something good for the international uh, community. You have many foreign investors waiting on the sidelines, willing to invest into India. So many good proposals for them, as well as there have been some dampeners in terms of the capital gains tax rate, which, as you know, has caused a lot of concern. Having said all of this, I would like to congratulate the finance minister and the government on continuing the path of fiscal prudence and making sure that they don't rock too many boats. So India is a beacon of hope in the entire global world, and we hope that it continues to remain so. So with that, I would like to open up the discussion. We will have 15 minutes at the end of the presentation for questions. You are free to write your questions as we go through in the comments or in the chat. Few of my colleagues would be looking into it. We'll try to answer them as we go along the presentation, or some of them would actually immediately respond on the chat. Uh, there's a lot to cover, so we will refrain from taking questions in between the presentation. With this, I would like to request my colleague Ishu to share the presentation and Sandeep and Ishu to start taking it forward from here. Thank you. Over to you, Ishu.
Thank you. Thank you so much. And, welcome everyone to the interactive discussion on the Union Budget 2024. So I'll just share my presentation and then start from there. I hope my presentation is visible to everyone. Yeah. So well, first, I'll tell you the flow of the entire discussion. How is it going to be? So basically, we are going to discuss the direct tax proposals first, and then the indirect tax proposals along with customs. So under the direct tax proposals, we'll be starting with the personal tax proposals, and then angel tax, and then IFSC gift city, and then going to the corporate tax proposals. And after that, we'll cover the litigation part and transfer pricing, assessments, and reassessment, and followed by the GST and customs. and some part of non-tax proposals which we think are, important to cover from the point of view of, if we bucket some, let's say, key non-tax proposals, then I think those were the proposals that really needed deliberation upon. So we'll cover that as well. So on that note, so personal tax proposal. So there is not much on the personal tax proposal. So as you all know, there are two regimes already, in our Indian income tax law for the individuals. It is old tax regime and the new tax regime. So there are no changes at all in the old tax regime. It continues to remain as it is. In terms of new tax regime, there has been some minor tinkering with it in terms of the slab rates. So there are three slabs which have been changed, whereas the tax rate remains same. So if you could see it in the in the deck in front of you, so I have highlighted number two, number three, number four in bold. So we have now new slab from 3 lakhs to 7 lakhs, and then 7 to 10, and 10 to 12. So earlier it was 3 to 6, and 6 to 9, and 9 to 12. So the 1 lakh incremental, uh, you know, uh, 1 lakh of incremental figure has been added to the new slab rate, proposed new slab rates. Along with this, a standard deduction is proposed to be increased from 50,000 rupees to 75,000. And as I mentioned earlier, that there are no changes in the old tax regime at all. So this standard deduction increase is in the new regime only. Further, coming to the section 57, which is about family pension. So there is a family pension deduction which is already there in the law to the extent of 15,000 rupees, and it has been proposed to increase to 25,000. Coming to the another leg of the personal tax proposal is the contribution which an employee and employer makes towards the central government pension scheme. So like you say, like you so basically it's a section 80 CC D subsection 2 that allows employees to claim the reduction for employers' contribution to the central government pension scheme, and that limit is only up to the 10% of the employee's salary as of now. So this limit has been proposed to be increased to 14% from 10%. And a very important point that I want to highlight over here, and it goes for the entire our budget discussion, is that most of the provisions will be applicable from assessment year 2025 and 26 unless stated. So there are some provisions which are effective from a particular date, and otherwise all the provisions would be, understood to be applied from AY 25-26 only. Another one that is, a kind of a loophole which was there in terms of classification of income in house property or a business income by some homeowners, till now. So basically, the loophole has been, kind of closed now. So what used to happen is there were homeowners used to classify their rental income under profits and gains of business or profession instead of the income from house property. So by classifying as a business income, they could take the reductions, and that could overall have a kind of reduced impact on their tax liability. So it has been clarified now that this kind of reporting of income in the incorrect head is not allowed anymore, and all the income from received by the owner from letting out of a residential property shall be chargeable under the head house property and not business, with effect from assessment year 25-26.
Just one quick addition to that. So
Yeah.
if a house property rental income is charged under business income, you can claim a lot of expenses and can reduce your taxable income to a certain extent. Uh, if you put it under income from house property, the deduction of expenses cannot exceed 30%. So 70% of your rental income has to gets taxed. What was happening was taxpayers were using this to claim a lot of expenses and reducing their taxable income to a substantial extent. That is why this provision has been brought in. Thank you.
Yeah, yeah. Thank you so much. Yeah, coming to the most talked about proposal in the entire budget, and there were many representations and there were many discussions even in the pre-budget memorandums, even in the, pre-budget discussions all over, that whether the existing capital gains tax regime should be, simplified. And so here it is. So we have a kind of, I won't say much of a simplified, but yes, a changed and a revamped, capital gains tax regime, which has been proposed by the Honorable Finance Minister, So basically, our the first point that we should highlight here is the indexation benefit, which used to be there for all the long-term capital gains and for all the long-term capital assets, has been removed now. So there is no such concept of indexation from 23rd of July. So I will not say AY 25-26 over there, because this particular provision is effective 23rd July 2024. And as I speak today on 25th, so if I sell some capital asset which is long term in nature for me, I will not be able to get an indexation benefit for that, which I would have got if I would have sold this on, let's say, 22nd July, one day even before the budget. So this was just to set the context. Now there are slew of changes, in the capital gains tax regime. One is indexation benefit removed, that I've already placed emphasis upon. Another one is the holding period. So there is no such holding period of 36 months now, which used to be earlier over there. And there are only two categories of holding period now. One is 12 months and 24 months. So just wanted to highlight, just wanted to, rather, there is only one provision in the income tax law which is not amended by this particular holding period change, is Section 50B, which is of slum sale. So I won't stress much on that, because that is related to business transfers and all. But there, the holding period remains 36 months. Otherwise, the holding period is only 12 months and 24 months across all the capital assets. So coming to the tax rate and the nature of the assets, so here all the listed equity shares, if you have held listed equity shares for over 12 months, you will have to pay 12.5% without indexation tax on it. Coming to the short term capital gains, there is an increase of 5% from 15% to 20% now. So all the listed equity shares, if there is a short term capital gain at the time of sale of listed equity shares, it will be taxed at 20% now instead of 15%. Otherwise, all the short-term capital gains, apart from the listed equity shares, will be taxed at the applicable slab rates. So this is one such big change in terms of tax rates, that it has been rationalized for all the asset classes in terms of long-term capital asset, that it is taxed at 12.5% across. And for the short-term capital assets, it will be applicable slab rates apart from the listed equity shares. One important point that I want to highlight over here, there were exchange traded funds, gold funds, and silver funds, which got bucketed into the debt category, after March 2023. That all those funds were bucketed into debt category, and they just lost the long term capital gains tax rate because of that. So now, with this change in the capital gains tax regime, it has been proposed that all those funds like ETF, gold ETFs and silver funds of funds, FOFs, will be getting the long-term capital gains tax rate 12.5% as well, if held over a period of if held over a period of 12 months or so. So that is one important thing. Otherwise, all the unlisted debentures, bonds, market-linked debentures, which were introduced last year via Section 50A, shall continue to be taxed at applicable slab rates with no holding period definition, because they are deemed to be short-term capital assets as such. And all the unlisted equity shares will be taxed at applicable slab rates. Important thing here is the long-term capital gains exemption limit, which was 1 lakh earlier for listed equity shares. So it has been increased to 1 lakh 25,000 now instead of 1 lakh. And this is about the capital gains tax regime. And I want to cover one small change from the capital gains perspective, which is on Section 47. That Section 47 says the transactions which are not regarded as transfer. So all the transfer of capital assets, which have been, given as a gift under, or under a will of an, irrevocable or an irrevocable trust, will apply only to an individual or HUF. So earlier, let me tell you, in section 47, in the relevant clause, there was no such condition of whether it has to be individual or an HUF, who is actually transferring the capital asset. So most of the companies also resort to, gift, also resort to take this route and take the benefit of Section 47. But now it has been explicitly clarified that this particular benefit, or this particular clause rather, will only apply to an individual or an HUF.
Just a couple of points on this issue. Just go on the previous slide.
Yeah, yeah,
So on
please.
the last point which he mentioned, so the logic is that only individuals, so gift has to be on account of love and affection. So obviously individuals can only exercise that. Companies cannot have love and affection for anyone. So that's the logic, and that is why this has been plugged. One more point I wanted to bring about. So I'm sure all of you would have heard the statements of the Revenue Secretary. The government is trying to justify the reduced tax rate, albeit without indexation. There's market participants as well as the middle class homeowners saying that the indexation used to provide them a lot of benefit. So the way to look at this is that if you have assets which have exceeded the inflation by far, that is where this reduced rate will really benefit you. So for example, many of our clients who are probably on the call also are very prolific startup investors. If you invest into a startup and it gets 10x, 20x in 3 years, 5 years, there's no way inflation can catch that. And therefore, a reduced rate from 20% to 12.5% will result in massive savings. Same is the case for house properties, homes. If you had properties which have not really increased in value, if they were less than the inflation or just matched inflation, probably you are better off with the earlier tax rate of 20% with indexation. But if in the last 3 years you have gained massively and it has been way over the inflation rate, then I'm sure the new proposals will help you a lot. So that is the underlying logic. So when you do evaluate, it's very easy to criticize the government a lot. We are hearing reports in the media, but this this low tax rate can actually benefit a lot of taxpayers as well. So just wanted to make that point. In fact, the income tax department has also released excels of scenarios where this reduced tax will benefit, and they're trying to make their point. I think the way they would have done the exercise would have been that they wanted to rationalize the rates, they wanted to reduce rates, didn't wanted to give any special treatment to listed shares. They tried to bring the long-term capital rate, but when they looked at the revenue figures, they wanted to do a balancing act, and therefore they increased it by 20, I mean by 2.5%, which is 25% of the existing tax rate, to make up for any shortfall of revenue. So probably there was more of a mathematical adjustment. But overall, as I said, for asset classes which have really done well, or for your investments which have really done well, I think this new rate is going to really help. Oh, Ishu, please, next slide.
Yeah, yeah. Thank you so much for doing deliberation on that. And coming to the example you've already spoken about, that Income Tax India has actually on its Twitter handles has actually given some examples wherein it has been try to show that the new regime where the benefit of indexation is not there can also be beneficial. So I completely agree with you that it is very easy to have an opinion that if an indexation has been done away with, then it will not be beneficial for the common man at all. So it's not the case. So it all depends on the returns that you have generated from that particular asset. It depends. It's a case by case analysis. So you cannot say that if indexation has gone, so there is nothing left and it's all a hard hitting tax outflow that you have to incur. So it's not like that. Depends on case to case. So coming to examples here, if you see, there is one example wherein the property has been purchased in, let's say, 2009-10, which is almost 15 years ago. So if I take the if let's say, if suppose the indexation would have been still there, would have been still here, right? So it cost of acquisition, for just for the purpose of understanding, it's rupees 100, that I have purchased a property for 100 rupees in 2009-10. Taking it, with the indexation benefit and all, I come to around 2.45. So this means 100 invested in 2009-10 is equivalent to 2.45 times of 100 today. That is 245 rupees. So let's say I have taken four scenarios wherein I have taken different sale value numbers. So at one scenario, I have sold it at 700 rupees. And if I go by the old capital gains tax regime, my capital gains, for example, turn out to be 455 rupees, and the tax is 20% on it because it's an immovable property. So 20% tax on the 455 will come to 91 rupees. And if I go by, the new regime, of course, I cannot take the benefit of the enhanced indexed cost of acquisition, which is 245. I will just be able to, allow to subtract 100 rupees from my sale value. So it is, let's say, 700 minus 100, it's 600 is my capital gain under the new regime, and 600 into 12.5. So it's 75 rupees. So you can see the comparison here. Even if, I have taken the indexation benefit, my tax is coming out to 91 rupees. And by not taking indexation benefit, the tax amount is coming to 75. So this example in itself shows that it all depends on your holding period at the first place. All depends on the returns. All depends on the dynamics, such as at which value you have sold your asset and what is the cost of acquisition and all. But mostly in terms of immovable property, which has been a big news all over, that it is a very big hit to the taxpayers across, for the property sellers. It's not the case. It may be a hit for some, but let's see, even if at the time of rationalizing any provision, there will be some of the category, some of the taxpayers which may be adversely affected. But and in the long run, or in let's say in the times to come, they may realize that it's also beneficial to their own advantage as well. So in terms of immovable property, simply speaking, whether new regime is beneficial to you depends on one of the main criterias, and that is the percentage of return that you have made at whatever appreciation you have received over the years. So it all depends on where what regime will be beneficial to you, and we all have to accept that this is the new proposal, and we have to compute our capital gains at the time of sale of assets according to the new regime only. Coming to the another tax proposal, which is a very welcoming move by the government, and it was also subject matter of various representations made before the government before the budget came, that angel tax should be abolished. So angel tax, just to set the context, it came in 2012 as a recommendation of the committee on the white paper on black money. So for all our overseas, connections who have spare time to attend this webinar, so the it is an Indian term for the tainted money. So basically, it is what used to happen is people used to invest a lot of in private companies via share capital at inflated premiums. So there was a view that it was increasing, it was resulting in the increased circulation of the tainted money, or the unaccounted money in the system, by making companies and investing as a share capital in those. So in 2012, this particular provision came in to plug this law abuse. And in 2023, this was also extended to non-residents investors. So for example, if somebody is investing from out of India in a privately held company in India, the angel tax provisions could hit that investor as well. So it was a matter of worry, for especially for startups, because they received lots of notices, questioning on the valuation, questioning on the the share issue and the money that they have received. And abolishing this is actually a sigh of relief for them, and it is also very good for the company, for the India's investment climate, I would say. But I'll also stress upon one particular provision in the income tax law, which is still there. It has not been abolished. That's Section 68, which is unexplained cash credits. So what Section 68 does is, Section 68 gives the power to the tax authorities to actually tax the particular amount credited to the bank of a particular company or a taxpayer if that company is not able to explain the source of that amount to the satisfaction of the tax authority. So they can tax that amount as income in the company's hands. So that they I think this one particular provision still can hit the companies in terms of raising investments and everything. But I don't see it much of an issue from the point of view of denting, or from the point of view of discouraging the investments to come to India. So I don't see there more of an issue. Rather, it's a welcome development from the government side.
Just one last quick comment. So, angel tax, there were a lot of carve outs in this provision. There were recognized startups which are exempt from that. Uh, the 68 section basically triggers uh, when the investee companies are not able to prove the credit worthiness of the investors. The main issue has been that tax department wanted all investors data, their balance sheet, their tax returns, to come to a conclusion that yes, they were genuine and they had enough capital to invest into these startups. Startups having 10, 20, 40 angels had a horrid time collecting that, and they were in no capacity, or they couldn't ask for tax returns of the ultra high net worth individuals. So 68 was a very, very difficult section to comply with. There has been a lot of issues, notices, additions on section 68, because even though the money, the investment was completely genuine, there was no way that the startup would have complied with getting these details for all the investors. Just wanted to make this point. So this still remains, but yes, the good thing is angel tax has been abolished. Caused a lot of controversy, and like Yeeshu said, it was actually used as a route to launder money. That's why this anti-abuse provision came in. So we feel that there was still some mischief which will be done by taxpayers. Let's see. Thank you.
Yeah. So, with an aim to, popularize the cruise ship, entertainment mode in India. So this is a new section which has been proposed to be inserted in the Indian tax law to incentivize or to give benefit to the non-residents who are into, for cruise ship businesses. So there is a new section 44 BBC which is proposed to be inserted to give a to give a presumptive tax regime for the non-residents cruise ship operators, wherein 20% of the amounts received by them from their customers would be deemed to be the taxable profit on which they have to pay the tax. So it is actually a big substantial benefit to incentivize tourism, to actually promote tourism in the country. And this kind of I'll actually like to put forward here another section which is 44B, which is already there in the Indian tax law, which taxes the shipping companies. So shipping companies talks about that you have to pay 7.5% tax. That is also a presumptive tax section wherein you just have to pay 7.5% of your income, as declare it as your taxable income, and you pay tax on it. But now with this particular provision, taking the cruise ship operators specifically out from that shipping company section and asking them to pay 20%. So not sure how is it going to be seen by the cruise ship operators who want to enter into India or who want to operate in the country, because our honorable prime minister is also placing a lot of emphasis on local tourism and promoting the tourism. So all in all, a very good kind of a proposal to promote tourism, but not sure how is it going to be dealt with when there was already a section for shipping companies which was asking 7.5%, as which was deeming 7.5% of your income as a taxable profit to 20%. So we have to see this in the times to come. Coming to Gift City and sovereign wealth funds. So Gift City, like there has been a lot of boost and support from the Indian government to promote Gift City over the last few years. And in every budget, in every year, there is something or the other in terms of benefits or incentive given to the Gift City. So this budget is no different coming to on that front. So there are some sunset dates which has been, in the form of deadlines, which has been extended for the non-residents who are engaged, in the leasing of aircraft business or the shipping businesses. And also one thing that there are couple of new benefits which have been proposed is Section 68, which we were actually talking in terms of angel tax. That Section 68 is still there. Uh, that can actually bring those money credited in the bank account of the companies under the tax remit by the tax officer. Section 68 gives an exemption to the venture capital funds which are already regulated by SEBI. So in this budget, it has been proposed that Section 68 will also not apply to the venture capital funds which are regulated by IFSC regulations. So that's a very welcome move, I would say. And also thin capitalization provisions. So thin capitalization is actually uh, basically wants to restrict your interest deduction to 30% of EBITDA whenever you pay the interest to any associated enterprises. It is it comes under the transfer pricing category, which my colleague Manish will take it when he'll be dealing on this. He'll be dealing with the transfer pricing proposals. So I'll just cover it in brief. So thin capitalization provisions will also not apply to the finance companies which are operating in IFSC. So that also is a very welcome change and promoting and boosting the gift city overall. Coming to the sovereign wealth funds, so sovereign wealth funds, they are government investment vehicles. They have been invested, and the surplus funds have been invested by the government in a vehicle, and that's called a sovereign wealth fund. So Abu Dhabi Investment Authority is one of the renowned and notified sovereign wealth funds by the government of India. And what has happened is to enjoy the Section 1023 FE exemption, which talks about the exemption of dividends and interest and long-term capital gains to these sovereign wealth funds. The investments must have been made by 31st March 2024. So we are sitting in 2024. So in a move to actually promote and to give more time to sovereign wealth fund investors to actually invest in India in infrastructure projects, etc., this timeline has been extended to 31st March 2025 now. I'll just give the floor to my colleague, Mr. Sandeep, to take it ahead in terms of buyback and other corporate tax proposals. Over to you, Mr. Sandeep. Thank you so much, everyone.
Yeah, thank you, Yeeshu. Thank you so much. And very welcome to the August audience here. So, coming on to the other proposals related to corporate taxes, I think the first important amendment is with respect to the taxation of buyback. So prior to 2019, the buyback was treated as dividend income. Now the same position has been restored now, and the effects of this would vary depending on who you talk to. So let's say if you talk to the foreign shareholders of an Indian company, I think they would be very happy because earlier when the buyback was taxed in the hands of the Indian company, the foreign shareholders obviously would be bearing that cost in the form of reduced dividends. But now they would be able to take the benefit of the tax treaties and even if there is any withholding in India, they would be able to take the credit of that in their own jurisdiction. Obviously, depending upon the relevant laws in their own country. And let's say if you talk to the domestic holding company, I think they would be kind of neutral because they would be allowed a deduction under Section ATM, uh, particularly when they are distributing dividends onwards to their own shareholders. And the purpose of the ATM, as we know, is to remove the cascading effect of dividend distribution down the line. But if you talk to the other shareholders who are Indian residents, I think for them it is a kind of a blow because then now earlier the cost for them was 20%, but considering that it would be taxed as dividends in their own income and they would be taxed at the slab rates, so their taxation could go as high as 37%. You can move on to next slide. Yushu, can you move the slide? Yeah, thank you. Yeah. So I think this budget has come with a lot of surprises as well. Some have been some are pleasant and some not so pleasant. But if I talk about this equalization levy, and I think this is a very good move, because I think introducing this levy only created more complications for the industry as such. And I think, I mean, we also came across several incidents where the payers in India, or or the foreign companies, and even the tax department, they were not on the same page whether a particular income would be treated as a FTS royalty or it would be subject to EL. In fact, there have been cases even if the foreign companies have discharged liabilities with respect to EL, the tax department would try to tax as FTS, because they would take a stand that okay, even if you have paid the EL, it doesn't mean that you have been absolved. So I mean, it doesn't mean that the tax department cannot evaluate your position as to whether you would be subject to could be subject to tax as royalty or FTS as such. So I think that created a lot of complications, and I think withdrawal of this EL 2.0. I think it is the after effect of the recent agreement between India and US, where they agreed to extend the level till June 2024. Uh, and here I would like to mention that the older version of EL, which was introduced in 2016, which was a debate of 6% on online advertising, I mean, that has not been done away with. That is still very much in place, where the Indian companies are required to pay deduct 6% at the time of making the payment if the payment exceeds 1 lakh annually. Uh, now, now let's say, I mean, considering as an after effect, now I think there is a clarity from that respect that the foreign companies are sure that okay, their income would only be could only be subject to as royalty or FTS only, and they can avail the treaty positions as such, whichever are available to them. So now we can
And,
move on to the next. Yeah,
Sandeep, can I just add a few
sure, sure,
points?
sure,
So
sure, sure.
this EL was introduced. So we had a BEPS action plan at the OECD level where the entire international taxation system underwent a change. All countries tried to come together to come to a conclusion. Action Plan 1 dealt with digital economy. So most of these companies which were providing digital goods and services were escaping taxation. Equalization levy came in two parts. The first was when 6% levy was introduced on these digital companies providing online advertisement. And then equalization 2.0 came, which was at the rate of 2%, which was on uh, digital services other than advertising, including e-commerce. But typically, they talked about e-commerce most specifically. Um, Unfortunately, we had cases where clients were in fact uh, are being asked by the deductors in India. If so, US multinational providing digital services to Indian resident companies, they were asked to withhold taxes. And we had cases where we came to a position that equalization levy is applicable, and therefore this income is not subject to tax. Unfortunately, the deductors in India said, we don't believe in that position. We believe that services are still taxed. Non-resident kept on paying equalization levy, and the deductors kind of took a position that they wanted to deduct taxes, or you go to the tax authorities to go a lower rate certificate. So this sometimes, obviously, this led to a double whammy, and there was a lot of controversy, like Sandeep mentioned. Uh, as of now, even though this is a good step, but it has more come from the pressure of US, I think, because US initially opened up an investigation a couple of years back on unfair trade practices by which included India and 10 more countries. They said that we have been discriminated against. This is not the right levy. However, whatever India did was what other countries were doing under the aegis of OECD. Um, Even though OECD never mandated anybody, but they just gave recommendations. So India went ahead with that. This unfortunately caused issues. US threatened India with tariffs. Then US came to the table. There's still discussions going on. And as we go towards a consensus and the implementation of that, hopefully these digital companies would start getting taxed. But India has done away with a lot of revenue, and this was leading to good amount of revenue. And as of now, we are again back to the square one. So Indian tax authorities will definitely try to tax these services. Just wanted to say that, please.
Ishu, can you move the slide? Yeah. So another important proposal which affects foreign companies is reduction in their tax rate. So as we know, the foreign companies are typically taxed at the rate of 40%, except in case of special incomes like dividend, FTS, which are subject to tax at the rate of 20% under Section 115 Capital A. So typically, if any foreign company has a PE in India, maybe in the form of a branch office or a project office, the income of that office would be subject to a tax rate of 40% on net basis. So now that has been reduced to 35, and in a way that has kind of brought a kind of parity between the tax rate applicable to a wholly owned subsidiary of a foreign company and the vis-a-vis a branch in India. So let's say, I mean, if you talk about a subsidiary, if it earns a profit of 100 rupees, so typically it would be paying a tax of corporate tax of 25%. And on the balance 75, if the amount is distributed as dividend, then the tax rate of 20% is applicable under 15 capital A. So the net would be around 60. So the net tax rate would be around 40%. Uh, Obviously, the foreign companies can avail treaty benefit where the tax on dividend could be reduced to 10 or 15%, which would effectively bring down the overall tax impact to like 33 to 41%. However, now, as I mentioned, since the branch would be subject to a tax rate of 35%, which is somewhere around this tax rate only. So that's why I said now there is a kind of a parity where there is no tax arbitrage as such between setting up a branch or a PO or a subsidiary in India. Obviously, the all the other compliance requirements under Companies Act and the other laws will need to be taken care of. But at least from tax perspective, I mean that parity has been achieved. Uh, Issue one next slide. Yeah. So moving on to other important proposals which have been introduced in the budgets. So I think one of the important proposal is to the facility of availing a lower rate certificate for the provisions under Section 194Q and 206C. So obviously on the sale of goods exceeding 50 lakhs, there was a TDS of 1.1%, which was introduced, I think, 2 years ago. So there were a lot of companies or the startups which were incurring losses who would be subject to this 0.1% TDS. Later on, obviously, they would be able to get the refund, but it would have led to unnecessary blockage of the working capital in their hands. So I think this is a good move where they would be able to secure this certificate from the tax department and would be able to avoid this withholding, and they would be able to free up their working capital. The other important amendment is respect to Section 198. So 198, as we know, is the provision which says that any form of withholding is effectively your income. So I think there was no clarity with respect to the foreign tax credits which were being availed in India while filing the tax returns. So whether if there has been any withholding carried out overseas and you take credit in India, some of the taxpayers could be offering the income of a net basis, which in our view was not a correct practice. And I think that has been rationalized where it has been clarified that any amount of withholding which has been done overseas, which is creditable in India, the gross amount before the withholding should be considered as an income. However, there also, I mean, there could be an interpretation issue that whether the income would be only that particular part to the extent the credit is allowed in India, or the actual withholding which has been carried out. But I think the if you look at the wordings of the provision, it says that uh, a tax is paid outside India against which a credit is payable. Had the intention would have been to restrict it to the amount of credit actually availed, so maybe the provision would have worded in a manner like to the extent the credit is available in India. And I think that is not the intention. So that's why I think the prudent view here seems to be that the gross withholding which has been done overseas, those gross taxes which have been paid overseas should be considered as income in India. But obviously there could be different situation with respect to US. For example, in US levy state taxes in federal taxes. So what would the treatment with respect to state taxes, whether those would, because ordinarily the state taxes are not allowed as a credit in India. So I think from that perspective, I think a view is possible that maybe state taxes may not be considered as a part of income, and those can be still availed as deductions from the income which is offered in India. And I think there are certain rulings which support this position. Uh, the other important provision is respect to the correction of TDS statement. So as we know, practically speaking, there was no timeline by which you can revise the TDS TCS return. So now the legislator has put a date. Okay, I mean you can revise any return for a particular financial year till the end of the sixth financial year from the end of that financial year. So we can move on to the next slide. Yeah. Uh, and yeah, so I think there was I mean the provisions for SSC in default generally provided a timeline of 7 years after the financial after the end of the financial year, in which you have in which one may have committed a TDS default. So now this timeline has been reduced to 1 year. Now effectively it is 6 years. And I think other important aspect worth noting here is that if there was a default with respect to payment made to any non-resident or a foreign company, the, there was virtually no timeline prescribed or limitation as to that, but by what time you could be considered as an SSC in default. And I think this is an important amendment where they have put the timeline for 6 years, where the default is respect to payment made to a non-resident or a foreign company as well. Uh, The other is rationalization with respect to the interest on late payment or TCS. TDS, as we know, attracts two different rates, 1% for late deduction and 1.5% for late payment. And I think it has also been rationalized where the 1.5% interest rate now is applicable to the late payment or TCS as well. Another important proposal with respect to TCS on purchase of high value goods. So I think these go. So I think as we, I mean, at the amendment was brought in last year, where if somebody purchases a car, when having value more than 10 lakhs, that was subject to 1% TCS. So now I think the ambit is getting widened, where not just a motor car, the other luxurious items which could be, I'm not sure what would be prescribed, but we have to wait for it once the list is prescribed, but it could be paintings or maybe highway or maybe be luxurious furniture or whatever. So I think one needs to be ready for that as well. So we can move on to the next slide. So I think I mean, the First Amendment with respect to certain bonds. I mean, the floating rate saving bond now they would also be subject to withholding the interest payment exceed 10,000 annually. Earlier, they were not subject to any kind of withholding. Similarly, the any repurchase of units by the mutual funds, which could be in the form of redemption, is everything. Those were subject to 20% withholding tax. Now that withholding has been done away with. The other rationalization is with respect to the TDS reduction under 194C, where certain payments uh, which could also be subject to tax under the provisions of 194J. Uh, I mean, many taxpayers were claiming that it would qualify as a work and could be subject to TDS under 194C at the rate of 1% or 2%. So I think the legislature has now made it amply clear that uh, the priority should be given to 194J, and if the payment gets classified in 194J, then the 194J prevail over that. Uh, So another important amendment with respect to the clarification with respect to 194 IA, where 1% deduction is made with respect on purchase of a house property or any real property where the value with the transaction exceeds 50 lakh rupees. So I mean there was no clarity as to, let's say, if the property is being owned by two or three different people, whether this 50 lakhs limits would apply to each individual separately or it would be the whole property. So now they have made it clear that it should be on the value of the property. So even if there are different co-owners and their respective share doesn't cross 50 lakhs, but if the value of the property exceeds 50 lakh rupees, then in that case, the TDS withholding for 1% would apply for every single individual in this case. So we can move on to the next slide. Yeshu, can you move? Yeah. And I think this is I mean, some of the TDS rates have been rationalized where where the earlier tax rate of 5% has been reduced to 2% in several cases. For example, I mean, payment for life insurance policy, lottery tickets, etc., and maybe on brokerage and other similar items. And I think for 196B and 196C, I think it has there the withholding is already 10% for certain certain foreign foreign or non-resident taxpayers like offshore banking units, etc., which were subject to a tax rate of 10%. Sorry, withholding of 10%. So now, since the tax liability for the long-term capital gains have been increased, uniformly increased to 12.5%, I think they have rationalized it so to make it par with the actual tax liability of such units operating in India. So we can move on to the next slide. So there have been some changes with respect to the taxation of partnership firms, where the remuneration payable to partners is also now attracts withholding if the payment exceeds 20,000. So that would attract a withholding of 10%. And the limit uh, for the remuneration payable to the partner, which should be exempt in their hands, that has also been increased from 3 lakhs to 6 lakhs. So we can move on to the next slide. Yeah. And they,
Sandeep, can
yeah,
I
sure,
just make one
sure,
point?
sure, sure.
So I think all the TDS provisions have been rationalized and diluted to a certain extent. I think that's a fair comment. In fact, even the prosecution provisions, which my colleague Manish would later on cover, I think rates have come down substantially for many cases. Working capital relief has been given, and prosecution provisions have also been diluted a bit. Uh, and it's probably, have we covered the salary part, the TCS credit for salary taxpayers? Uh, uh, Sandeep, are you covering that after?
No, so I think that is not covered in our slides,
Okay, so probably
but we can
that's,
talk
yeah,
about
I
it.
thought so. So just one important point, I think, uh, when for a employee, if you have TDS withheld, um, in some cases, when especially when you had children going abroad for studies, you were made remittances under LRS. There was a tax collection at source TCS. Um, what was not allowed was the TCS credit was not given while doing a withholding of taxes, which prime because of that, people used to file returns and claim a refund of all the TCS which has been deducted. Government has brought in a very good provision. They have said that while doing the withholding of TDS, uh, TCS credits would also be considered, and accordingly, less withholding would be done. So that's one important point I thought I will just try to add to this. So a lot of rationalization, good things in TDS and TCS provisions. At least to in that portion, government has done quite a bit. Thank you. I think there was a question hand raised. So probably if you can just write in the chat box, that would be great. We'll pick up that question. Please continue, Sandeep.
So yeah, so I think there have been some rationalizations with respect to the taxation for charitable trust or the NGOs, so to say. Uh, so I mean, if you talk about the the tax regime for the NGOs or charitable organizations, so there are different provisions scattered across different parts of the Act. For example, if you talk about 1023C and 11 to 13, they would generally talk about similar kind of entities or the trust. I think the attempt has been made to rationalize it, where they're saying that okay, if you would get classified under 1023C, down the line you would need to make application only under section 12 AA or 12 AB, whichever is applicable to you. And 1023C would be shelved down the line. And I think the transition has started where they're saying that from 1st October onwards, no fresh application for exemption under 1023C would be accepted by the tax department. And And as an after effect, some transitory provisions have been introduced where the investments which were made for under 1023C, where you can keep your money in different forms, those would be considered as, I would say, sufficiently compliant under the provision under the requirements of 12AB or 12AA as well. So I think that is a good move, and I think as we have been hearing that the government is also looking to, I would say, maybe rationalize the whole income tax set. I think this is a step in the right direction where you may not need to create different categories where the same object can be met at by one or two provisions as such. The other important and the good move is with respect to condonation or delay, as we know that since I mean the regime change for charitable trust, which has been made in the last 1 or 2 years, has been very cumbersome as such. And during the process, there have been many charitable organizations which may not be able to apply to the tax department for the exemptions within due time. And I think when the power has been given to the principal commissioner that okay, if there were sufficient genuine reasons and the condonation should be allowed to them, I think the principal commissioner would be able to apply their discretion. And I think in genuine cases, the exemption should be allowed and by granting them the registration for whatever period is allowed. So we can move on to the next slide. Yeah. So, I mean, there are other important provisions which are dealt with here. One of the important provision is amendment made in section 37. So, I mean, when 37 also makes it clear that if you have violated any law and you have paid any penalties or fines, those are generally not allowed as a deduction under the provisions of section 37. But I
Just one
think,
second.
yeah,
Sorry, just one housekeeping item. Uh,
yeah,
Please, the chat has been blocked for this webinar. Can you please put your questions in the Q&A column, in the Q&A tab? That would be great because everyone is muted. We would not be able to take up questions by unmuting you. If you can put questions in the Q&A, we'll immediately take it up. Sorry about this. Sandeep, please go on.
sure, sure. So now the amendment which has been made in section 37 is that okay, if you have committed any contravention and for that purpose you have paid kind of a settlement fee or something or any kind of settlement. So it means that basically you have admitted that indeed there was a contravention and the amount paid for that condonation or we could say compounding would not be allowed as an expense. So typical example is the compounding fee paid under the provisions of FEMA where certain offenses may have been committed and there are provisions available under FEMA where you can pay some compounding fee and get the offense compounded and there would be no further aggressive actions like prosecutions or heavy penalties. So I think that compounding fee or other similar items would no longer be allowed as a tax expense while computing the taxable income. The other important provisions respect to the 49C filing for the liaison officers in India, they are not required to file a tax return, but by the end of May, they are required to file a form called 49C where certain reportings are required to be made. So till now, there was no penalty prescribed as such, even though there was a due date and it could have been contested that okay, it would fall under the general provision. But now a specific penalty has been inserted where uh, delay, I mean, where the 1,000 penalty of 1,000 per day would be levied on such liaison officers who do not file these returns timely. But this fee has been kept to 1 lakh rupees. Uh, the other important provision is to rationalization of TCS for the minors. So as Amit was talking about the TCS for the salaried employees as they were not able to claim their TCS, the companies were not allowing them TCS while calculating their tax liability for the purpose of withholding from their salary income. I think the similar rationalization have been provided here, where one could be using the allowance limit of their children as well. So the children in this case would not have their own income, so they would not be claiming, so they would not be filing their tax returns. So in that case, the parents have been allowed that they can claim the TCS which have been collected on the account of their children. And I think suitable amendments will be made in the return form where I think you may need to put the PAN numbers of the miners. So we'll need to see what kind of mechanism is provided. But the bottom line is that you will be able to claim the TCS which have been withheld for for the minor child whenever you have made any allowance remittances. So from here onward, I will pass on to my colleague Manish, who would talk about the provisions related to transfer pricing and uh, others procedural provisions under the Income Tax Act. Thank you so much.
Thank you, Sandeep. So hello everyone, and warm good afternoon. And so I'll be covering about the topics or the changes which have been made, which have been proposed in the budget with in relation to the direct tax litigation and the transfer pricing. So starting with the direct tax litigation, so our honorable finance minister has really lived up to the expectation of the industry, if not on the personal tax front, but at least on the direct tax litigation front. And I will say like tone was set 4 or 5 years earlier when in 2020 amnesty scheme was rolled out, which demonstrated the government's motive or agenda to curb the litigation, to reduce the number of appeals or the assessment, streamline the assessment procedure. So since many budgets, the changes were being made consistently, but this year I will say this budget, if not transformative, at least close to transformative on this front of direct tax litigation, because many changes have been introduced. If we would be talking about all the changes, then it would have already taken, more than couple of hours talking about all the changes. But we will be covering the key provisions which will impact the last section of society, industry, taxpayers. So starting with the changes made in the assessment provisions related to the cases where the search is carried out in section 132 and the 132A. So first, I'll start what is the history. So, like assessment for the search cases is one thing which has seen lots of changes in the last 10 or 20 years. The latest one being in 2021, when the assessment for the search procedure was merged with the reassessment provisions. Means the manner in which the reassessment was to be carried out, the same manner in which the assessment for the search cases was also to be carried out. This not only added the complexity, but also added the administrative burden on the field officers. So there was many internal representations as pointed out by finance minister in her budget speech. So that's why the mechanism for assessment for the block years has been reintroduced now by putting a whole new section 158. So what this section will do, so here the AO will assess the once the search is carried out and the assessment has to be carried out, then they will carry out the assessment for the whole block, and the block will be for 6 assessment years, and those assessment years will be the 6 assessment year immediately preceding the previous year in which search is carried out. So it will not only reduce the burden on the tax officer, because earlier they were carrying out the assessment for the search cases year on year. There was all documentation formality, there was the formality related to inquiry, because that is what the reassessment mechanism is in section 148. So now there will be the separate assessment for the 6 year together. This will save on lots of time and cost for taxpayer as well as the department. So I will be covering the key provisions here in the new section. So as I mentioned, the search will be 6 years. It will be a consolidated assessment. Uh, and once the assessment is carried out, so if there is any earlier proceedings, for example, it could be transfer pricing proceedings, it could be any assessment, reassessment, revisionary proceeding, every proceedings will abate. They will no longer exist. So this is a very key change which has been brought in the new change that has been proposed in section 132A search cases. So no new proceedings will start and earlier proceedings will also abate. And then there will be 60% tax on the undisclosed income, which will be determined through the assessment in the search cases. And there is no 234A, B, C interest. There is a separate interest of 1.5% interest per month. And there is a separate 50% penalty. And if during the assessment, if there is it is determined that there is a loss, then it will be ignored. If there is a income, then there will be no brought forward and unobserved depreciation to be allowed to set off against those undisclosed income. So these are the main changes with respect to rationalization of provision related to assessment of search and seizure cases. Ishu, can you move on to second slide? Next slide. Yes, so this is one very important update. This is in relation to 148, Section 148 reassessment, which has seen a wave of litigation in last 3-4 years, right from the 2021 when these provisions were revamped. So now the government has really acknowledged the pain of taxpayers because they are repeatedly going to High Court and Supreme Courts with the writ petition and the special leave petition, and we have been representing our clients in many such cases where we have to go for a writ petition only because the new section was not very happily worded. There were the procedural complexities which were not being complied by the tax officers properly, and that was leaving a loophole for assessees to approach the high court and just get their petition, get their assessments, reassessments dropped on those parts. So acknowledging all these things by the field officers as well as taxpayers challenges. So the section 148A has been substituted with the new section 148A. The most of the provisions in the section have been same. It's just been some the inquiry procedure and everything has been little bit strengthened so that there are no more loopholes and it could save us the time and cost of both taxpayers as well as department. The major or the noticeable changes in the reduction of time limit. This is something which will provide the tax certainty to industry as a whole. So earlier there was a time limit of 3 years and the 10 years till when the tax department could have opened your case. 3 years when that amount of income escaped is less than 50 lakhs, but if it is more than 50 lakhs, then up to 10 years your case could be reopened. But now the 3 years limit has been kept same, but the 10 years limit has been reduced drastically to 5 years. Now this will provide a lot of certainty to the industries, to the clients, because because till now they have to be unsure about what is going to be in store for at least from the reassessment perspective for the next 10 years. But now they can be this will bring a cheers for them. At least after 5 years they can say like they are free now. Tax department cannot reopen the case. So this has been one transformative change as far as from the taxpayers front is concerned. Issue, can you move on to next slide? Now this is again a change in section 148 reassessment mechanism. This is more of a procedural internal change. So department like the assessing officer before reopening your case has to take approval from the specified authority from his seniors. So earlier the authorities were principal commissioner, principal directors, commissioner, principal chief commissioner. Now the rank of the officers have been changed and now they can move ahead with reopening the case with the approval from additional commissioner, additional director, joint commissioner, joint director. So this is again move to reduce the administrative burden on tax officers. So this was all about changes in the section 148. So again, I will reiterate the importance of the reduction in the time limit from 10 years to 5 years. Aishu, please, next slide. Yeah, so these are the changes which have been made in appeals. So earlier when the search used to be carried out and the assessment is made, so there was a 50% penalty provision. So once the penalty order is passed, so those penalty orders were not appealable before the ITAT because that was not in the list of appealable order as provided in section 253 subsection 1, but this was also a procedural lapse. So to address this, the government has rationalized this section and they've included the section 158 BFA penalty orders in the list of appealable orders. So now assessee can file appeal in ITAT for these orders as well. The next change in the with respect to time limit for filing the appeal before ITAT. So the time limit has been kept same, I will say, but the provisions has been streamlined because earlier the time limit used to be 60 days from the date of receiving date of receiving the final, I will say, appealable orders. It could be CIT order, it could be any penalty order. So since everyone has moved to faceless regime, so now the orders are communicated the same day when they are generated, unlike earlier times when it used to take 10-15 days to courier the order and receive the order. So it was becoming very difficult for tax department, or the I will say IT to count the time limit every time, because they have to uh, do the counting day by day. So that's why, just for ease of compliance, they have now proposed like the new time limit will be 2 months from the end of month in which the notice or the order is passed. So now it will be very easy to track the deadline for them to file the appeal. So now one more important update, which I will say has the capability to reshape the litigation or the appeal landscape, because the backlog of appeal has been a matter of concern for central government in the last few years. There was a recent RTI according to which more than 60 lakhs appeal were still pending at the level of CIT and ITAT. So that shows a huge number. So resultantly, the people were losing confidence in the appeal system. So just to recognize this, the government has, the limit, they have enhanced the monetary limit below which, if there is any tax effect which do not cross the monetary threshold, you cannot technically file the appeal. So this move is more towards, preventing the tax department to file the unnecessary appeals in the higher authorities, because we see in a lot of cases the department unnecessarily pursue the appeals, and this adds to the time and the cost of the taxpayers as well as tax department. So that's why they have increased the threshold significantly. If you want to file appeal before ITAT, earlier threshold used to be 50 lakhs. Now, if the tax effect is less than 60 lakhs, you cannot file appeal to ITAT, and it is for both taxpayers as well as tax department. Similarly, for High Court, it has been increased to 2 crores. For Supreme Court, it has been increased to 5 crores. So now only the matters involving sizable amount of additions and the tax effect can go to the higher authorities. This will definitely, if it will not reduce the backlog, at least it will prevent the creation of further backlog. Issue next slide, please. Okay, so this is also one important update which no one is very few people are talking about, but it has a large implications, which is enhancement in the power of CIT appeal. So till now, CIT appeal can only confirm, reduce, or cancel the assessment, but they were not having the power of setting aside with the direction of fresh assessment to assessing officers. So that is why so especially in the budget speech as pointed out by Honorable Finance Minister, so there was a lot of times the assessees, do not respond to the notices issued by assessing officer, and the department has to do a 144 assessment, the best judgment assessment. So if those cases go to CIT appeal, they add to the backlog. Right, so that's why the CIT appeal has been given power, especially relating to the cases for the best judgment assessment, and they can set aside with a direction for the fresh assessment to assessing officer. So now this is a welcome move, but again, this is very doubtful, like how effectively this change will be implemented, because we have seen the in the past, like ITAT on some other matters, many matters I will say, they if they find any factual error or some factual scope for any factual error, then they tend to set aside the matter with a fresh assessment to assessing officer. So obviously, assessing officer will now be burdened with the heavy work. So it will again dilute the quality of assessment that is already like if you ask any taxpayer, you ask the consultants like us, the quality of assessment is not that great because the amount of time the people in hand is not satisfactory to understand the submissions of the assessee. So I doubt like this is a welcome move, but the quality of fresh assessment or this will overall impact the quality of all the assessment that assessing officers take. So, another change I will talk about is also important change. So in the recent years, government has focused to digitalize the taxpayer services. We know like most of the tax services have been made electronic, assessments have been made faceless, but still there are so many proceedings which are happening offline, like rectification 154 proceedings and order giving effect applications. So then the government has acknowledged these, like they are working to make these proceedings also digitalized in the over the period of next 2 years. But again, there will be the question of how effective these proceedings will be if they'll be made online, because order giving effect and the section 150 proceedings are such proceedings where you most of the time require interaction with the tax officers, because if you're going to get something rectified in section 154 proceedings, you need to explain them, because we have seen a tendency of tax officers not to understand much from your submission. So we have to, we used to go and explain them the each and everything, how the and in the order giving effect application as well, because sometimes the ITAT and the high courts, they give a very limited direction. So those direction have to be clearly explained to officers and they accordingly pass the order. So again, this is a welcome move, but again, how well this will be implemented will depend upon how well this is perceived by tax department. We can only hope for the best. Ishu, please, next slide, please. So this is I will say the highlight of this budget, which is Vivad Se Vishwas scheme. So, like garnering from the success of the 2020 scheme, same scheme, Vivad Se Vishwas scheme, the government has acknowledged or realized like there was not only the collection of the additional revenue, but this scheme was praised by taxpayer community because that gave them a chance to come clean and just to get over the litigation, repetitive litigation procedures. So again, this scheme has been launched. The new provisions in the new scheme have been more or less same. It's just that earlier you were paying 100% of the disputed tax if you want to get away from the litigation. Now, there is 10% more. I will say you have to pay 10% more of disputed tax if your appeal was filed before 2020. The logic is that government is asking you if you have missed the 2020 train, you did not sit on that in that train that time, and you want to sit in the train this time, then you'll have to shell out 10% more. So you'll have to pay typically 110% of the disputed taxes if you want to avail of this scheme. And again, there is a multiple variety of rates if you do not pay interest, if you do not pay the disputed tax on or before 31st December 2024, then you'll have to shell out 120%. So this is what has been the highlight of this scheme. One noticeable change this has been made this time is you can opt for VSVS 2024 in relation to appeals which are pending before DRP. So lots of transfer pricing appeals which are filed in before DRP, those were missing out from the earlier scheme. Now taxpayers can opt for BSPS for those cases as well. But again, transfer pricing assessment, we usually see the transfer pricing additions are made in big cases, or wherever the transfer pricing assessment are made, the amount involved is huge, and chances of getting relief at a higher appeal forum is very high. So how much the people will actually opt for VSVS scheme in transfer pricing cases will still remain a question, but government has given you an option and you should welcome this. Um, Next slide, issue. So this is alternative. So this is relation to advanced ruling. So if just giving you a history in 2021, the authority for advanced ruling was made ineffective. The ruling the authority for advanced ruling was diluted. from 2021, and all those pending application before AAR was transferred to newly constituted board for advanced ruling. So those who do not know about much about advanced ruling, so this is the option given to non-resident people if we they are contemplating to enter into any transaction which will have taxability in India. So they can go to advanced ruling, authority for advanced ruling, and then they can get some judgment from them like this will be the treatment of their transaction. So this was to give confidence to the people who are thinking of doing FDI in India and doing business in India, so they can go to authority for advanced ruling and get the certainty, get a judgment, and that judgment was binding on the authorities. But now, since 2021, this authority for advanced ruling was discontinued, and all those pending applications were transferred to board for advanced ruling. Now this board of advanced ruling is something, if they give any if they give any judgment that is not binding, they are appealable to high court. So there was no more attractiveness for the taxpayers, because if the tax department will anyway litigate it, so there is no certainty, which was the main point of attraction for the non-residents to opt for advanced ruling. So still those applications were pending. Government gave them 30 days if do you want to withdraw, but the people did not withdraw. But 4 years have passed. Most of those applications are still pending because there are the administrative issues and people not finding much confidence because these judgments have made appealable. So that's why they wanted to withdraw, but 30 days time limit has already lapsed. So the government has now introduced one more section in which the time limit to withdraw the application have been extended till October 31st, 2024. So those people who want to withdraw but were not able to withdraw because the time limit has lapsed, now they can avail this. So next slide, please. Now this is a very welcome move by because we see a lot of wave of litigation on these issues. So what the prosecution proceedings for TDS are? Section 276B contains the stringent provisions relating to imprisonment for the directors of the company or for the assessees if they do not deposit the TDS before the due date of depositing the TDS, which is 7th of the next month. And although this is a serious offense, if you deduct the money which belong to other, which actually belong to government, and you're not deducting the TDS, but sometime maybe due to the people issues or maybe some administrative issues, even there are the bona fide reasons, or there are the small delays, maybe 1 week or 1 month. Still, the tax department used to launch the prosecution proceedings, and this prosecution proceedings is itself a, I will call it dramatic proceedings, because you have to, fight a long battle. You have to appear before the session courts, and they will summon your directors, and it is a dent on the image of multinationals if the question. Especially the cases where the delay was bona fide, not very substantial. So government has acknowledged this problem. They have now given additional time. If you're not able to deposit the TDS up to the date of filing the quarterly TDS returns, still the prosecution proceedings will not be launched against you. So this is a very welcome relief, especially in the cases which are bona fide and the delay is not substantial. So these are the changes in relation to uh, Benami pro Benami Property Transaction Act 1988. So earlier, I will count on the key provisions here, which has been insertion of Section 55A. So earlier in
Maybe
Benami,
I can, Manish, sorry to interrupt.
sure,
Maybe I can pick up this. I'll just
sure,
give
Amit.
more context. So everyone, hi. We have a white collar crimes defense department in the firm which deals with these laws. So Benami law, the Black Money Act, Money Laundering Act, PMLA, FEMA, etc. So we do practice this often, and Benami provisions, Benami law is quite old. It came in 1988. It lacked teeth, and there was not much movement. Tax authorities were not able to catch many Benami transactions. This law was then overhauled. It was there were a lot of more powers given to the tax officers, and so they are called initiating officers, sorry, in this act. So this act was given more teeth. However, in the last few years, we have observed that it was still very difficult to catch hold of Benami transactions. So imagine somebody having a property worth crores in the name of their drivers or in the name of their staffs, lower rung staff who get very small salaries. So it was very difficult for the department unless someone comes forward. How do they know that this person is holding a property worth crores, especially where there was lack of digitization of records, and it was difficult to correlate such data. So unless you really raid uh, a taxpayer and look into their lockers, there you find that, oh, this they have these property papers lying with them which are in the name of their servants. So it was very difficult to catch hold of them. So they have brought this very interesting change, which would be a game changer. So they have said that if so, the Benamidar and the beneficial owner are obviously two people involved in this transaction, or there could be some conduit. So they have said if the Benamidar or the other person involved, the third person involved in the transaction, if they come forward and if they become kind of they become evidence gatherers, or they provide in evidence against these people, so they will be granted immunity from both penalty and prosecution if they cooperate. If they do not cooperate, then these people, this immunity would be withdrawn. So provided there are certain conditions are met, uh, these people can actually come forward, give testimony against the beneficial owner, and would be given full protection under the law. As of now, as the law stands, benamidar as well as the beneficial owner are levied the same penalty. So imagine a servant of a beneficial owner being levied crores and crores of penalty. So they were very afraid to even come forward. So this this is an important game-changing development, and the rest of the provisions are mostly very procedural. I think we are also running a bit short of time, so I won't cover that. But they are mostly in relation to extension of time limits in the hands of the initiating officers to give them more time to complete assessments, to issue notices, and to wrap up assessments. So we won't go into too much details, but I think that was the most relevant part, and this is a real game changer. Manish, over to you next. And I think we need to hurry up. I think our colleague Ikesh also has a lot to cover in indirect taxes. So let's quickly move and just cover the main provisions on the tax front, I think.
Sure, Amit, sure. So next big change is with relation to black money. So this change reflects upon the government's commitment to give relief to the honest taxpayers. So those people who have undisclosed foreign assets and they do not disclose in the income tax return on they do not file the income tax return if they have their foreign tax assets, then there is a very harsh penalties and the tax amount. So there's a 30% tax and a 90% penalty, and then there is additional penalty of 10 lakh rupees. So as far as additional penalty of 10 lakh rupees is concerned, that has been done away with. If you have acquired the foreign assets from your tax paid money and you failed to disclose this in ITR, or if you have filed a ITR, if you have not filed a ITR and you just if you have filed and you have failed to disclose, so this is a welcome move, because lots of people who have purchased the shares of foreign company, or the people who work in a private sector and they have been provided ESOP by the parent company, they often miss to disclose in the income tax return and have to face the proceedings. So now this is a huge relief for them. So with that, we are closing all the key changes of the direct tax litigation. Coming on the transfer pricing, issue next slide, please. So the scope of the specified domestic transaction has been increased when it comes to scrutiny by transfer pricing officer. So earlier, if assessing officer has made reference for any case to TPO, and they have not specifically mentioned in the notice about the specified domestic transaction, then the TPO was not having power to verify this. But now they have included the power the power to verify the SDT in the list of powers of transfer pricing officers. And then another change is exclusion of finance company from the scope of section 94B. So 94B is a section which often called as a thin capitalization rule, which puts a restriction of 30% restriction on the claim of interest paid to foreign associated enterprises. So this was made in line with the base erosion and the profit shifting plan of OECD. So again, there was some exclusion like insurance company, banking companies, NBFCs, whose main business is obviously lending and borrowing money. So now the company incorporated in the IFSC, International Financial Service Center. So if any company is incorporated there, so those companies are also, free to provide pay any amount of interest. There will be no more applicability of Section 94B on those companies. Issue next slide, please. Okay, so these are the two changes which have been just made part of budget speech, but these changes have not been specifically quantified, but they are set the tone for the future years. First is expansion of the scope of safe harbor rule. So safe harbor rules are something which were introduced back in 2014, I guess, if I don't remember the year correctly. So these rules were made to provide a certainty for the multinational who are doing business in India, with an aim to reduce the transfer pricing litigation and provide certainty to the scope of their transfer pricing applicability. But the rates margins that have been provided in the safe harbor rules are higher, and there have been very few takers of the safe harbor rules. So this has really become unattractive, which has been acknowledged by government, realized, and they have now decided to increase the scope. It will be interesting what changes they bring, so it become attractive for the multinationals. And now the second change which they have promised is TP assessment procedures to be streamlined. So obviously there is a need to streamline the procedures related to transfer pricing assessment as well, which I think will be the part of overall comprehensive review of the direct tax system, which Honorable Prime Finance Minister has promised. So with that, we end with the transfer pricing proposals. I will now I will request Ikesh, my colleague, to take over the indirect tax proposals.
Thanks, Manish. So, good evening, everyone. A very warm welcome to all of you. So, we are running little short of time, so I will be little quick on the updates. So, if you will move to the first slide. Issue, can you move to the first slide? Sure. One of the most important changes what I feel is that which have been made in section 73 and 74 and the insertion of section 74A, that the section 73 and 74 is now applicable only till 2023 and 24. Section 73 basically deals with non-fraud cases and section 74 deals with basically with fraud cases. So earlier the time limit was different in section 73 and section 74, which I have already provided in this scenarios in the chart, basically table form I have provided. So due to the common different time limits, lot of times notices have been issued by the officers since the time limit have been over in the cases of section 73, that is the non-fraud cases. So in that cases, fraud cases have been initiated against the taxpayer. So that is why a common limitation, time limitation period have been introduced from 2024 and 25. So in cases, one of the benefit of having a common limitation is that where notices are being issued now under section 74, the time limit for non-fraud cases is lapsed. So with the common limitation, we won't face such issues. So now earlier, the time limit to face the notice under non-fraud cases was 2 years and 9 months. However, now it is extended to 3 years and 6 months. So for non-fraud cases, the time limit to issue the notice is extended. However, in the time limit to issue the notice for fraud cases is reduced by 1 year. So earlier it was 4 years and 6 months. Now it has been reduced to 3 years and 6 months to issue the notice. For issuing the order, for non-fraud cases, earlier the time limit was 3 years, but now it have been extended to 4 years and 6 months, which can further be extended by the approvals of the commissioner or the whosoever officer has been approved by the commissioner above the rank of joint commissioner by further 6 months. So essentially it will again make to 5 years. That is similar to fraud cases. So essentially we can say that non-fraud cases time limit for issuing the order have become will parallel to the fraud cases. So the now time limit to avail the reduced penalty is reduced from 30 days to 60 days. Like if you have been issued a show cause notice earlier, if you have paid the tax and interest within 30 days, if you pay the taxes with interest, you get a benefit of reduced penalty. Now the days for paying the taxes with interest have been increased to 60 days. Similarly for fraud cases as well. Along with that, the monetary limit has also been introduced, since it was seen that in a lot of cases where the demand were raised even for 400, 300 rupees for the tax amount. So now a threshold of 1,000 rupees is set. So below that will not notices for below 1,000 rupees shall not be issued. So if we'll move to next slide. So with respect to section 74 and section 73, insertion of section 75 is also being made in a subsection of 2A, which clarifies basically that if there is a case of fraud, it is not being established under the appeal by the appellate authority or appellate tribunal, then it shall be considered as a non-fraud case and penalty shall be levied accordingly. So it is quite similar to what we have right now under section 73 and 74. So now with the there is an amendment with respect to section 9 that that was basically there was a dispute between the center and state that this should the ENA and rectified spirit used for manufacturing of alcoholic liquor for human consumption, was it under the state who can apply VAT or the center? So there was several discussions between the GST council meetings to that this should be excluded from the GST. Now it have been introduced that this shall be excluded from the GST and maybe the VAT shall be applicable on that. But again, it is disputable because of the constitution amendments which have been made. With respect to time of supply under the RCM. So a recent circular was issued that was 211, which was issued, which clarified that invoices on which RCM is applicable, and if payment is not done, even if the payment is not done, input tax credit shall be available on the basis of self-invoicing. So let's say if we have issuing the supplier have issued, unregistered supplier have issued us the invoice in, let's say, year 2022, but we have taken or issued the self-invoicing in 2024. Even then we can avail the input tax credit, but the RCM payment shall be made with interest accordingly, and the section 122 penalty shall also be leviable. So accordingly, now the changes have been made under section 73 for the time of supply, section 13, sorry, with respect to the time of supply. So now that invoices shall be issued earlier of the following, that is the date of payment 60 days off from the date of issuance of supplier, or the date of issue date of invoice issued by the recipient. So whichever is earlier, accordingly the time limit shall be set. So respective changes have been made in section 31 as well to issue the time the invoices within the time limits, and accordingly it have been clarified that the government entities which are unregistered basically or registered only for tedious purposes shall be considered as unregistered. So if we can can we move to next slide, please? Now, with respect to this is a very welcome move that GST Council was recommended section 128, and it have been adopted by in the budget. That section 128A basically gives the waiver of interest and penalty in non-fraud cases from 2017, 17-18 for financial year 18-19 or 19-20 for the if we have paid the full tax amount, and if the interest is not paid, interest or penalty waiver shall be paid if the full tax amount is paid by the specified date. However, specified date is yet to be notified. If notice is issued, now in which cases the benefit shall be available? If the notice is issued by the officer, but order is not issued. For 17, 18 and 18, 19, the time period for section 73 is already lapsed. So accordingly, it shall be applicable only for 2019 and 20 for the assessing officers, right? But if the case is under appeal and appeal is filed under the appellate authority, but order is yet to be issued for the non-fraud case, in that cases, if we are paying the taxes without interest and penalty, the waiver shall be allowed. Similarly, if the case is pending under the appellate tribunal, in that cases also the benefit shall be available. However, the appellate tribunal is not yet set. However, in addition to that, if the notice is issued under section 74 and it have been settled that this is a non-fraud case, again the benefit shall be available. Now the irony is that no refund shall be available for the taxpayer who have already paid the interest or penalty as a tax compliant person. So if I have paid taxes along with interest and penalty even against the notice without any order, even then I won't be able to claim it as a refund. So this is a little disconcerting. Along with that, there is an insertion of section 16.5. A retrospective change have been made from 2017, which is a very welcome move because a lot of taxpayers who were not able to claim their credit in initial years under section 16.4 within the time limits. That was earlier, it was September 30th September due date, but now it have been extended for all these years from 2017 till 2020-21 till 30th November. So basically, if I have claimed the credit even after the specified limit of section 16.4, I can avail the credit. It was respected. A lot of cases were filed against the constitutional validity of the section 16.4 as well. In the Supreme Courts, the cases are already going on. So accordingly, now the big relief is being given to these taxpayers. A lot of litigations were going on that the time limit cannot curtail the benefit to the taxpayers. So accordingly, now the benefit is given to these taxpayers that they can avail the benefit for the same. A relief is also being given to the taxpayers whose registrations were cancelled and then the registration was revoked. In such cases, the taxpayer can avail the ITC as per section 16.4 prescribed limit, or within 30 days from his registration is reinstated. So that is a very welcome move. Both of them will provide a great relief to the taxpayers. So Yeeshu, can we move to the next slide, please? Yeeshu, I think we have missed this is not the slide.
Maybe just go, is this the slide or just go a couple of slides ahead? I think that's what Ikesh is looking for.
So this is a previous slide. Can we go to the next slide? Yeah. No, Yeeshu, 37 should be the slide.
Yeeshu, can you go ahead? Can you just go a couple of slides ahead, please? Just do one more, 36, 37, 38. I think there's some. Just go ahead. One more, please. Okay. No problem. Probably since we are almost on time, maybe Ikesh, do you have any other comments? Do you just want to talk about the customs duty, or do you want to comment on anything else?
A couple of changes I will cover with this respect, that the appeal provisions have been introduced. with respect to this, that 50 crore pre-deposit limit was reduced to 40 crores in appellate authority, and appellate tribunal pre-deposit of 20% is being reduced to 10%. A big relief is also provided to insurance sectors. Now it have been provided that no supply of goods and services shall be considered if the insurance services are provided by the co-insurer or reinsurer to the lead insurers. So earlier, and it is not covered under the ambit of supply. Ideally, it should not have been covered initially, because that was the case under service tax as well. But there was clarity required. But now this clarity have been provided, but not retrospectively. And along with that, there is another just concern that no refund shall be allowed to these taxpayers if they have paid the taxes or input tax credit have been reversed with that regard. So I will move very fast with respect to sections 11A have been introduced, where the government have issued that the tax who have was not charged or paid correctly because of the common practices in trade, so that they can give the relief to the businesses with that respect. So we might expect maybe in secondment or online money gaming or corporate guarantees where the common trends were there, they have not paid the taxes. So through this section 11A introduction, the government might give this as a relief. So with respect to other changes, the export of goods with payment or without payment, earlier there was a, if the goods were subjected to export duty, earlier only for without payment, basically refund was not allowed. For with payment, there was a little disconnection between the with payment and without payment method. So now it have been introduced that in even in cases of with payment, if the goods are subjected to export duty, the refund shall not be allowed. And a sunset of anti-profiteering clause have been introduced. Along with that, e-commerce retrospective amendment is there for the e-commerce industry, that the company the e-commerce companies which are subjected to under section 9(5), that the penal provision shall only be applicable to the e-commerce companies who are subjected to TCS, and not to the e-commerce companies under section 9(5), like Ola, Uber, or Zomato, or companies like this who are covered under section 9(5). Just for an example, I'm covering this companies. So now we are done with the indirect tax proposals. If you have any questions, you may please enter it in Q&A sections. Sir, it is over to you.
Also, I think we would like to probably just take up the questions now. We have already sent out our budget updates, a full document to all our contacts. I'm sure you would have received that. Many of these non-tax tax proposals, including summary of the economic survey, are already covered under that. But just as a theme, I think there's a lot of focus on generating employment in this budget. There are a few employment-linked incentive scheme which will increase formal employment. I think the government is working hard because India, even though is growing at a fast pace, has not been able to keep up giving jobs to all people who are looking out. So there's still the issue of unemployment. So we have these wage subsidies around 15,000 Indian rupees for 2 years. We have certain other incentives where top 500 companies have to provide internship to around 1 crore youth. Now, these kind of schemes would encourage and further incentivize people to opt for or to promote jobs and to provide more opportunities to our youth. The Revenue Secretary has also said, in fact, this came in the Economic Times today, that they have said that we just want there is already a good momentum and we just want to further it. And we want, very importantly, that we want less of automation and more of labor. So India already has a lot of youth coming into the workforce. And unfortunately, automation would hit the employment. Government has said we cannot force anyone, but we are giving you a slight nudge that please generate employment. Just don't only rely on automation, even though that may make companies more efficient. So we just feel that this could probably provide an impetus. One issue which industry has pointed out is that the government is saying that the internship allowance would be 5,000 rupees per month. In certain industry, it is actually more than that. Some of the industry folks and uh, manpower supply companies are saying that there is a possibility that companies will now start taking this as a benchmark and will restrict the allowance to 5,000. So if somebody was paying 10,000, 7,000, 8,000, they'll probably restrict it to 5,000. So that has been a challenge. And one good thing is they have allowed these internship and training costs to come out of the CSR funds. So I think all in all, these are good changes, but there's much more detail in the budget document which you have already sent. The intention was to cover the direct and the indirect tax proposals. So we still have 8 minutes left. We would love to hear any comments, questions, any clarifications you want to provide. If you can just write on the chat, we would be able to take it up. We can also follow this up over emails if you have questions, if nothing comes to your mind right now. Somebody is asking, is ATC still there? Yes, that's definitely there. No changes. Maybe Gaurav and team, if you can even unmute or just allow people to even just unmute themselves and ask questions, since we are almost through into the last few minutes. So I think Manish, would you like to take the question of Jaspreet? She is asking about Black Money Act, and I think her question was probably that 5 lakh exemption was only applicable to bank accounts. Okay, let's take it from first Bhuvneshwar Agarwal. I
Yeah,
think he has raised his hand. Please, sir. Happy
yeah.
to
Good
answer that.
evening, all of you, and
Thank you.
congratulations
Good
to
evening.
the AKM Global team. Definitely, it went on well, and it has been very smoothly. All the provisions, all the sections have been elaborated, and it is really great to understand the each section so quickly within. I think it was almost, I should say, 2 days. It's really the hard work which has been put up by the team of yours, by the different functions, whether it is direct, indirect, customs. So I should say thank you to all of you. And it's too early for us to ask question immediately because there are many reading in between the lines. So definitely we'll come to you. But it was overall a great presentation and a great elaboration of the subject. Thank you. Thank you, AKM Global team. Thank you so much.
Thanks a lot. Thank you, sir.
That's all from my side. Thank you.
Thank you. Thank you. So, Manish, would you like to take Jaspreet's question quickly?
Sure, sure. So as I can read, I think Jaspreet's question is power to set aside by CIT appeal has been provided only in the case of order under section 144. Jaspreet, you're correct. This power has been given to CIT only in respect of the base judgment assessment, which is under section 144.
There's also a question from Jaspreet on Black Money Act, which was sent 5 minutes ago.
I can't see it. Amit, can you please read it for me?
Yeah, so it's about what all can be included in the definition of assets or other assets except movables as mentioned in the exclusions. I think she's talking about the 10 lakh, the 20 lakh penalty.
Right, right. So, Jaspreet, we can, so other than immovable property, all those, financial interest you have acquired in foreign company, it could be shares, bonds, debentures, preference shares. It could be your bank account. It could be your shareholding interest in any other entity abroad. or you would be trading on the stock market, foreign stock market. So it could be anything other than just a property in the immovable form.
ESOPs also.
Right. Correct.
Any other questions? Please, you can raise your hands. You can unmute yourself. Happy to take up any question. So we will have a copy of this presentation also circulated. So if there are no further questions, we'll probably like to close this with a vote of thanks. Thanks for everyone for listening patiently. I know it went for 2 hours. There was too much information, but there were a lot of changes. We would recommend reading our budget update. And if there are any specifics which we can answer, we would be happy to answer that. I think Mr. B.S. Sharma from Mumbai has raised his hand. Please, sir, go ahead.
Good evening to everyone.
Good
Hello,
evening.
are you
Yeah,
are
we
you
can
able to
hear you.
listen?
We can hear you.
It has been a very good presentation. We have been listening to you, all of you, and it is more educative and more learning than what we have heard budget as such. Therefore, we are all thankful that if such webcasts are being telecasted, it would be to the benefit of all the chartered accountants and even others to learn something out of this and make their own planning according to the law which is now being introduced. I think it's a great thing and it a very good arrangement which you have made to make people to just tie up to you, and it is indirectly making your firm known to most of the people. I think it is a creditability which you have earned out of this program. No doubt it is a short program, but it has got more meaning than what it is actually being held for. Anyway, thanks a lot for all of you for the best presentation of the budget to everybody. Thank you very much.
Thank you, sir. Thanks, sir. Thanks a lot. We're glad that you liked it. Thank you. Anyone else? Okay. We just have a couple of minutes more left. Professor Gagan Quatra, please. Please go ahead.
You hear me?
We can hear you, please.
Yeah. Just to say something more about the way you have presented the whole budget in such a comprehensive manner. No, I being a professor at the OP Jindal Global University, I'm teaching this tax for the last 14 years. I'm in this field for now more than 50 years when I started my career. I mean,
Oh.
the way you have presented is, I think, very, very nice. I mean, this is the way communication skills are so clear. I want to compliment you, everybody. You're young chartered accountants or lawyers, I don't know your background, but you're doing a wonderful job. And in any case, you want to associate with us or we can associate with you in making presentations and expanding the knowledge to all around the world, including international taxation. We have 4 courses: international taxation, corporate taxation, tax administration, dispute resolution, and then GST. Almost everything we covered now. So I thought it is a good opportunity to first compliment you. You're a good leader. The way you coordinate is superb. And that's how I thought let me express to you. And keep on sending me your programs so that I can attach my students also to your program. And then in turn, they can understand. And we have a special course for master's degree, LLM taxation. Every year we have 45, 50 students doing masters only in taxation. So very interesting
Right.
for them. Thanks again.
Oh, thank you, sir. And we have immense respect for what you are doing and your university. In fact, I was invited a few years back. Unfortunately, was traveling, so couldn't come. I think it was for a lecture. So we also want to do our bit for the community and especially the students, young Indians. So if we can generate some interest in international tax, we would be happy to do that. So many of my colleagues here are prolific speakers. They contribute a lot to the Indian media as well. All of us who are on the panel right now. So happy to do our bit. We will be happy to join if there's any panel discussion, any course. I'm sure we will find time and give back to the community. We can, of course, talk about a lot of practical aspects and not only theory. So I think that's what would probably make us different. But you guys are the best educators, but we can probably share our practical experiences in a lot of cases.
So I'll be in touch with you. I have your number now.
Yes.
I'll just coordinate with your office, and my office will coordinate with you. And we'll have very shortly a program on either the suggestions, direct or indirect. And thanks for this sending me this mail.
Okay, thank you. Okay. So I think with this, we would like to close our presentation. Thanks again from all of us at AKM. And we would probably love to hear from you, any feedback on this webinar, as well as any follow-up questions. Thanks a lot. Enjoy your evening as well as your day for whoever is joining from overseas. I think there's one more question which has just come up. Let me just try to answer that. Okay. I think it's more of a thank you. Thanks, Pragati. Thanks a lot. Thank you. Thanks. Bye-bye.
Thank you.
Thank you
Thanks
Thank
again.
you everyone for joining. Bye bye.
Thank you.